Welcome everyone, happy Tuesday. Thank you so much for taking the time out of your day to join today's webinar, where we're going to be talking about some advanced self-directed investing strategies. It is top of the hour, so I want to be respectful of everybody's time. So let's go ahead and get started. I'm Reneika Lightbourne with Advanta IRA, and I'm truly delighted to be joined by the one and only Mr. Bryan Ellis. Thank you, Bryan, for being our featured speaker today.
My pleasure. Thank you for having me.
Absolutely. So Bryan's going to cover or kind of give us some insight on some of the more tactical and sophisticated strategies, specifically for business owners that have solo 401k. These are some of the things that he's seeing in the marketplace, some of the things that his clients are doing today to more so stay ahead or be prepared to capitalize on some of the many opportunities, but also mitigate some risk and then allow them to maximize retirement returns. Before I turn it over to Bryan, I do want to kind of give you a high-level overview of what self-direction is. If you have questions, feel free to type those in the question box. We'll answer those as we go, but also allocate some time at the very end for any additional questions. Again, I'm Reneika Lightbourne with Advanta IRA. I've been with Advanta, July will make exactly 4 years, so I started in 2019 as an employee, but I'm also an Advanta client. Self-direction is something that I actively do as well, and I think I've been a client since 2017 or so. If you have questions, if you want to kind of do a deeper dive or talk through your exact scenario, you're welcome to check out our website, advantaira.com, to schedule a consultation, or you can give me a call or send me an email directly. So just a little housekeeping before we get going. Do know that at Advanta, we don't give any tax, legal, investment advice. We just more so provide you the information for educational purposes. So as always, we encourage you, consult with your professional team. You want to do your due diligence before you make any investment. So quick takeaways, just know that any IRA or former employer plan qualifies to be self-directed. With self-direction, you're always in control, meaning you get to decide what is it that you want to invest in. And just know that all of the income that's going to be generated from the investment, whether it's an IRA or a solo 401k, flows back into the retirement account. Just a little history about Advanta and who we are. We've been in business for 20 plus years now as one of the leading self-directed IRA administrators in the business. Again, we don't give any tax, legal, or investment advice, but our staff will comprise of certified IRA service professionals. We do have attorneys on staff in-house to Advanta. Our headquarters is located in Largo, Florida, Tampa Bay area, but Advanta also has an office in Atlanta, which is where I'm based. But we do work with clients nationwide. We have a little over $2 billion under administration. Our focus at Advanta is just more so providing our clients that concierge style service where you do have dedicated account managers that help you complete the investment transaction on behalf of your IRA. And then, of course, having great educational content where we have experts and practitioners such as Bryan come in and knowledge share with you. This webinar is recorded. It's going to be on our YouTube channel within 24 to 48 hours. You can also check out our Advanta website, look at our video library, check out our events page for any upcoming events. Also, too, my colleague Alex does a podcast that's really good, so I encourage you to check that out. So just really quickly, I do want to highlight exactly what is a self-directed IRA. It just simply means that you as the account owner, you have complete control over your retirement funds, you have complete control over the investment decisions. You get to really diversify your retirement wealth. It's not tied to simply stocks and bonds. Most of our clients use retirement funds to invest in the likes of real estate. So whether it's going to be a fix and flip or a single family rental property or a commercial unit, we have clients that use IRA funds or solo 401k funds to invest in notes and mortgages, tax liens, private equities, oil and gas. The list goes on in terms of what's on the table for you. So why do people choose to self-direct? You can look to self-direct for many reasons. I'm just going to touch on 3 of them, which includes, it can be a new source of capital for you. So instead of taking out funds from your rainy day fund or taking out a personal loan, if you have funds that's sitting in an old retirement account, you can elect to move that over to make your next investment. Instead of dealing with the ups and downs of the volatility in the stock market, you can use your retirement funds to invest in real estate or some other tangible asset. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into that retirement account, tax-free or tax-deferred. In terms of the different accounts that can be self-directed, it's the ones that you're already familiar with. For individuals, you have traditional IRA, which is tax-deferred, meaning you get a tax break up front. Whereas with the Roth IRA, you pay taxes today, you grow that account over time. As long as you have that account for 5 years and you're 59 and a half, those funds, when you take it out, are tax-free. For employers or individuals who have their own business or side business, today Bryan's going to be focusing more so on individual K or solo 401ks, but you can certainly self-direct a SEP or simple as well. Some lesser known accounts that are also self-directed are ESAs and HSAs. For an HSA, you have to have a high deductible plan, so I encourage you to check out with your plan provider to ensure that you're HSA eligible. And then, of course, any former employer plan, whether it's an old 401k, 403b, or TSB type plan that can be self-directed. For 2023, contribution limits for traditional and Roth IRA, if you're under the age of 50, as long as you've earned income, you can contribute $6,500. If you're over the age of 50, you can put in $7,500 for SEPs. You can put in up to 25% of your compensation, not to exceed $66,000 with the solo 401k. And again, that's where we're going to be focusing more so today. You get to contribute essentially twice. You get to contribute as an employee, but also match as the owner of your own business, where you can put in up to $66,000 if you're under the age of 50. And then for ESAs, you can put in $2,000 per year per child. With an HSA, for an individual, you can put in $3,850. For a family plan, you can put in $7,750. Or if you're over the age of 55 with an HSA, you have an additional $1,000 catch-up. The process for us is pretty straightforward when you're ready to get started. Step one is completing the application process to get your account open, which we typically get open within 42 up to 24 to 48 business hours. And then, of course, you get to fund your account, which can include a combination of making an annual cash contribution if you're eligible. You can transfer from an existing IRA or do a direct rollover from an old employer plan. And then finally, start investing. What is it that you're interested in? Is it real estate based? Is it, private equities, oil and gas? The list goes on and on in terms of what's on the table for you. And with that, I'll go ahead and turn it over to our featured speaker, Mr. Bryan Ellis.
Thank you, Reneika. I appreciate that.
You're certainly welcome.
And it always gives me pleasure to refer my clients to you whenever they reach out to me to find out where they should go for self-directed IRA services. So it's been a pleasure working with you guys.
Absolutely, thank you. We appreciate our strategic partnership in terms of mutually assisting our mutual clients.
Absolutely. So, ladies and gentlemen, I have to offer you a bit of an apology today because for some reason my video system here is not working. I had planned to be visible to you, but you're not really missing much. Not getting to see me. Just listen, and we'll make this work. So here's what I want to talk with you about. I am going to be talking with you about something that is primarily useful within the realm of solo 401ks. Now, my suspicion is that the vast majority of you listening right now are not solo 401k users. You're probably self-directed IRA users. And so let's go ahead and deal with that right now. Probably a whole lot of you will be in one way or another eligible to use a solo 401k if you so chose. Not everybody, but a whole lot of you would be. So what I'm going to encourage you to do for the moment is, even if if you're not using a solo 401k, and I know that Advanta offers solo 401ks, even if you're not using that type of an account right now, let's just imagine that you have access to one, because again, many of you will qualify. And the particular strategy I want to share with you today really only works with a solo 401k, because that particular tool gives you tremendously more flexibility even than a self-directed IRA, which is hard to imagine sometimes because self-directed IRAs are so incredibly flexible. But I want you to just imagine with me for a moment, if you would, that in the world of IRAs, we have traditional and we have Roth, and you probably all know the difference, but just in case, a traditional account means that you get to take a tax deduction whenever you put money in, and that money is going to grow tax-free, and when you take the money out during retirement, you have to pay income taxes at that time. A Roth is kind of the opposite in terms of when you're taxed. You pay taxes, income taxes on the money before you put it into a Roth. In other words, you're putting in after-tax money when you put it into a Roth. Then it grows tax-free. And then when you take the money out during retirement, you don't have to pay taxes on it then, because you already paid taxes on it once. So one of them is pre-tax and one of them is post-tax. And which one is right for you is a question for your financial advisor, not for us to discuss right now, because that's kind of an individual circumstance. But here's my proposal to you. What if it was possible to get the benefits of both of them at the same time? Well, for a lot of you, it will be possible. And I'm going to give you kind of a case study that we're going to walk through so you can see roughly how that works. Now, one of the things that you need to understand is that self-directed IRAs, be they traditional or Roth, they are viewed, you can have one of both. You could have each of them. But they are, under the law, they are separate accounts, and the bookkeeping is done entirely separately for each one. They're not related to each other in any way. All right, so the assets in one are specific to that one, and the assets in the other, if you happen to have both, they're specific to the other. So they're not combined in any way. A solo 401k, though, is a different animal entirely. Depending on the way the documents are crafted, the underlying plan documents for the solo 401k. Solo 401k can actually have both a traditional side and a Roth side, and it's just a bookkeeping difference. All right. And by the way, before I go any further, I do want to tell you that I am going to tell you about a really cool strategy that will probably twist a lot of your minds and make you kind of run wild mentally thinking of all the possibilities. But I do want to point out to you that I'm just teaching you about this strategically. I'm not telling you that that you can implement this on your own, nor am I telling you that I will implement it for you. I will refer you to the appropriate attorneys who can handle this for you if you so choose. And let me give you my telephone number along those lines in case this turns out to be something that's of interest to you. Go ahead and write this down in case later on it proves to be relevant for you. That number is 770-833-8501. You'll know later if you need to text me and set up an appointment or not. But let's think this through for just a moment. In a solo 401k, depending on the way the plan is set up, it can have both a traditional side and a Roth side. That means that essentially you've got two different accounts in one plan. Now, that's a little bit hard to follow. I get it, because it's more complicated than self-directed IRAs. But just for the sake of argument, let's make it really simple and say that that a solo 401k gives you both a traditional account and a Roth account, even though it's technically not separate. But it gives you both of those things, and they can actually interact with each other, which is kind of a cool thing. So let's imagine for a moment, one of the, we're all into self-directing, and so that means that we're probably all kind of focused on alternative assets. And for me, one of the alternative asset classes that I really like the most is oil and gas. I think the more politically incorrect oil and gas becomes, the more attractive it is as an asset class. We won't go into why, but I love oil and gas. So right now, for example, just to give you kind of a rough overview, right now there's a project that I'm working on that it's an oil and gas project, and the buy-in for that project, it's a relatively low buy-in. It's a $25,000 buy-in per unit or per some portion of the project. And the expected cash-on-cash ROI for that is really quite high. It's it's quite a bit higher than certainly stocks, than most real estate, than most things, frankly. It is not to say that there's no risk. There's certainly risk. But let's just imagine for a moment that this project, which has a $25,000 buy-in, and it's got a projected ROI of roughly, let's just make it easy and say 100% cash on cash per year. Well, that's a crazy number, isn't it? But oil and gas is kind of like that. Whenever it works even reasonably well, the numbers tend to be pretty high. You don't make the numbers forever, but you do make them for for a number of years. And so let's just imagine that it did that. Well, one way that you could do that is that you could use a traditional IRA, buy that asset into your traditional IRA, and the money from it just lands back in your traditional IRA. Well, that's good because you're going to get some tax benefit, but it's bad because whenever you take your profits out during retirement, you've got to pay income taxes. Now, there's some different considerations with oil and gas too, because that's a different asset class, but we're just going to consider it simply for a moment. The other way you could do it is you could do the same thing in a Roth account and get some tax benefits whenever you do your withdrawal during retirement. And either one of those is very conventional, very much the norm in terms of the way you think about it. But another way that you could do this is that we could think a little bit more creatively and use a tool that is a very common tool in the world outside of IRAs and 401ks, and that tool is called a preferred LLC. And what is a preferred LLC? Well, you probably know what an LLC is. It's just a business entity. And a preferred LLC is just a specialization of that idea, such that there are two kinds of shares of classes of shares. One type of class of shares receives, let's say it was a 5% return preferred. That would mean that the person who receives who has preferred shares, they receive 5%, and they receive the first 5%, period. And even if that's all that the asset generates, even if it generates less than that, they get less than that. But if it generates 5%, they get all 5%. If it generates 50%, they still only get 5%. And whoever owns the other type of share, which is called a common share, they get the rest. So basically, one person is guaranteed a relatively small amount, but it's guaranteed. And the other person, the common share, receives whatever's left. All right, so that's roughly what a preferred LLC is. But let's imagine we use that kind of a structure inside of a solo 401k that has both a traditional account and a Roth account. You see, what we could do is we could set up inside of your 401k an arrangement whereby the traditional side of your Roth IRA is it owns the preferred shares of your LLC, and your Roth account owns the common shares of your LLC. Now, we're not going to get into the hard numbers of the distinction of why we do everything the way we do it, because I can't, as I mentioned to you, we have a little bit of technical difficulty, and I'm not able to show you the information on the screen in front of us right now. So I'm just going to give you kind of a narrative. But here's what happens. What happens is that the effect is that your traditional account is where just about all of the money comes from to buy this asset. And that's because your traditional account is the one that's guaranteed to get the first X% of return. Again, we'll say 5%. We'll come back to that number in just a little while. But your Roth account within your solo 401k, it receives the common shares. So let's talk about how that plays out in practice. Let's go back to that oil and gas unit that I mentioned to you just a moment ago. That's a roughly $25,000 buy-in, and it's the projection is, again, we're just going to make it simple and say 100% cash on cash for the first year and for several years thereafter. In that scenario, what would happen is that 5%, a return of 5% of that $25,000 would land in your traditional 401k. And 5% of 25,000 is what? That's about $1,250, something like that. Maybe a little more, a little less, something like that. I'm doing the math in my head at the moment. The other 95%, but if the thing generated 100% cash on cash, the other 100%, the other 95% would be distributed to whoever owns the common shares. And in this case, that would be the Roth side of your solo 401k. All right, now, and again, I have to apologize a bit because we're not able to show the slides to back this up at the moment due to some technical trouble. So this is a little bit more difficult to follow than if you could see it on the screen. But the bottom line is that you end up with some money in your traditional account. Basically, all of the money to make this investment comes out of your traditional account. The vast majority of it, almost all of it. And then your traditional account will receive 5% in this example of the return. And the remainder of the return goes into your Roth account. Well, just think about what that means. That means that, let's say in this example, we're talking about a $25,000 cash on cash return. That means that only 5% of that, $1,250 or so, roughly, will be taxable to you during retirement. The other part of the return, the other $23,750 or so, drops into your Roth account, and that will never be taxable. Now, I want to reiterate to you something that right here, that it doesn't really matter if you fully understand the machinations of how this works. In fact, I venture to say that you can't really possibly understand it without really seeing some slides in front of you, and I just feel terrible that it's not possible to show you the slides today. But the bigger point is this. The bigger point is that by thinking just a little bit creatively and using a tool that's a very common tool outside of the IRA world and the 401k world, but using that kind of common tool within the confines or the context of a solo 401k, what you get is a situation where you get to use pre-tax money that's in a traditional account. So you've taken a tax deduction for this money already. You use that money to purchase an investment. And the vast majority of the profits from that investment, even though they were done in a traditional account, because of the way that the whole thing is structured, the net effect is that the vast majority of the actual earnings from that investment, they land over in the non-taxable side of your solo 401k. What does that mean? It means that you're getting the best of both worlds. It means that you're getting to essentially put money into your traditional account and get a tax deduction for it, invest that money, and then a huge proportion of the revenue generated by that investment lands over in the non-taxable side of your account, so that you have a much lower tax burden whenever the time for your retirement comes around. It's kind of like having your cake and eating it too. This strategy, again, it's called a preferred LLC. This is one that's used by many really savvy investors. And I would encourage you, for those of you who have either larger accounts or particularly high yielding accounts, like if you have done reasonably well with your investments, such that your investments are generating good numbers, or you have a reason to expect that will happen in the future, this is something that you ought to seriously consider. And you'd only consider it in concert with advice from an appropriate self-directed IRA attorney and your own tax advisor, of course. But just imagine with me, if you will, what it would be like if you had used this strategy already on your assets, the ones that you own, because this can be done with anything. It doesn't require that you use an oil and gas investment. It can be an investment in real estate. It could be an investment in stocks. It could be anything at all. It's not specific to the asset class itself. It can be used with any asset class. The key is that your asset has to generate more than kind of a baseline, roughly 3 to 5% or so, and the IRS determines that. But your asset has to generate above that amount, because below that amount, that money is going to land in the traditional side of your solo 401k, and above that amount, the profits are going to land in the Roth side of your 401k. So the way to think about it is, what would happen if years ago, before you made whatever investments you currently have on, what if you had done this? What if back then you knew how to do this and you understood it and you decided to do it? Well, what that would mean is that the vast majority of the profits that are now in your traditional account that you'll have to pay taxes on later, well, if you had done this back then, you wouldn't be paying taxes on the vast majority of those profits whenever you take them out during retirement. This is just a much smarter way to use self-directed retirement accounts. Now, it's not plausible. It's not a good strategy for low yielding investments, like a lot of people choose, and very rightfully so. A lot of people will choose lower yielding investments because they're maybe more predictable or safer, or they're just more comfortable. And so if your investments are only yielding 3 to 5%, or maybe not much more than that, then you probably wouldn't want to do this, because there is some cost to setting it up. And the cost is going to depend on the types of assets you're using and the complexity of it. But it's probably going to cost several $1,000s to set something like this up. But just imagine what, like, even in the single example that I gave you of that one oil and gas project, if that thing produces even half of what they're projecting, it would save you more taxes than that in just the first year. So it's really what I want to do is encourage you folks to think about the possibilities of using a strategy like this preferred IRA strategy, to get more out of your self-directed account, to do more than you otherwise would be able to do. Because none of this stuff is, not only is this not prohibited in any of the IRS code, but investing in LLCs, which is all we're doing here, we're just setting up the LLC with special language in it that makes it work with the 401k. The notion of using an IRA or 401k to invest in an LLC is a common thing. Probably many of you have done that already. All we're doing is just using a distinct type of operating agreement in that LLC that makes it possible for your to produce these rather substantial tax benefits. So that's kind of the 50,000-foot overview of what I have for you today. And I do want to tell you that there are a number of other really powerful creative strategies that can be used, particularly if you happen to be a person who wants to get a whole lot of money into an IRA, more than and particularly for 401ks, you're gonna find that most of the flexibility on the really creative strategies comes with 401ks rather than IRAs. There are just there are so many ways to be creative with these things that it will make your head spin. You can do far more with these things than you have ever dreamed possible. And again, what we're talking about today is basically getting the benefit of tax deductibility going and coming. You get to put money into your traditional account and take a deduction there, but still have the vast majority of the profits from that transaction land in a Roth or a tax-free account later on, so that you never have to pay taxes on the vast majority of your profits. That, ladies and gentlemen, is a way to tremendously amp up your returns and to make your golden years a lot more golden, because you get to keep a lot more of your gold. So with that, I am basically done with what I had to share with you today. I want to give you my telephone number one more time. That's 770-833-8501, 770-833-8501. And don't call me if you want to talk. I'd be happy to set a time to talk with you. But instead, just text me, or you can email me at the address you see there on the screen, brian@bryanellis.com. Either way is fine. Just either email me or text me, and we'll set up a time to talk. And if this is a good fit for what you need, I'll be happy to make some suggestions about the attorneys and the other professionals that you would need to make this sort of thing happen. Because again, we don't provide this service. I'm not a lawyer. I'm not a CPA, anything like that. I don't presently, but I have taught tax law about self-directed IRA law through the University of California in the past. So I know a thing or two about this, but I'm not a lawyer, and so we don't implement this. But I do have a number of really trusted attorneys that I can refer you to that can help you with this sort of thing in the event that it is a good fit for you. So Reneika, that's what I got for you today.
Thank you so much, Brian. Yeah, absolutely. Mind blowing in terms of the strategic advantage or opportunities that's out there, specifically with solo 401ks. I do have some questions. I do want to reference, yes, this webinar is recorded. It's going to be uploaded onto our YouTube channel, generally within 24 to 48 hours. So just bear with us for that. Brian, first question is, in your example, wouldn't your returns be subject to the trust tax rate because this is an equity investment? Yeah,
that's a completely good point. There are some ways, lots of ways to mitigate that, but yes, the answer to that is yes. So if you want to make it a simpler example, let's just imagine it's it's a real estate transaction that's yielding the same kind of return. But you're totally correct in thinking that this would be subject to different rules because oil and gas is taxed a little bit differently. So yes, you're correct, but the example still stands if it was any other, just about any other asset class.
Okay, next question. So does it have to be or does this strategy only work with a preferred LLC?
Can you say that one once more?
The question is, does it have to be a preferred LLC, meaning, or does it only work using a preferred LLC?
Yes, the way to do this is with a preferred LLC. There may be other legal structures that can emulate a preferred LLC, like a corporation, for example. But there's some good reasons to do it with an LLC instead. So that's the best strategy by far. Okay, next question is, if I have funds already in a traditional 401k, can I move them to a solo 401k to get returns tax-free via Roth? For a whole lot of people, the answer is yes. What I would do is recommend that you reach out to Reneika privately and just go over with her whether you qualify for a solo 401k, because the requirements are a little different than the requirements for a self-directed IRA, but a whole lot of you likely will be able to qualify.
Okay, next question is, you mentioned that you have attorneys. Do they work with clients nationwide, or are they just specific to certain states?
Yes, my attorneys will work with people nationwide for sure.
Okay, next question, piggybacking on that is there an estimate in terms of cost to set a preferred LLC up?
Yeah, I mean, it depends on the asset that you're using and how complicated it is, but I'd say on the low end, it's going to be a few $1,000s up to, if we're talking about a multi-million-dollar transaction or maybe even multi-$100,000, it might be 10 grand, as high as 10 grand, depending on the specifics of your project. But what you'll find is that you can pretty much invariably save more than that amount in taxes just on the first year income. So the good thing about it is that you can have some clarity before you ever make the decision of whether to do this on whether it's going to financially make sense to make the investment or not. So the wise thing to do is, if you think this is a suitable thing for you, reach out and let's find out roughly how it would impact you. And then if it doesn't make sense tax-wise or expense-wise for you to do it, then just don't do it. But if it does, it'll be obvious to you and you can move forward accordingly.
Okay. Next question is, does this strategy only work with a solo 401k and not with IRAs?
That is correct. This is specific to solo 401ks. You would not want to do this with 401ks due to some of the prohibited transaction rules. I won't get into that, but this is not something you want to do with IRAs.
Okay. Same person. Next question is, how could a traditional side invest a lot more than the Roth side, but receive much less than the Roth side? It is not clear how this works from your presentation without the slides.
Yeah, so it's very perceptive of you to follow that. So the answer is that in the real world out there, like I mentioned, preferred LLCs or preferred stock corporations are very, very common. Like they even trade on the public market. And so the distinction between preferred and common shares, either of LLCs or corporations, is that preferred shares get their money first, and they always get their money first. And so for that reason, the preferred shares, particularly when they're privately held like this, preferred shares tend to be more valuable, substantially more valuable, because they get the money first. And the common shares, they might make a lot more, or they might make none at all. So the common shares are worth a whole lot less. So essentially what you're doing here is you're using your Roth account, and you're putting up just a little bit of money through your Roth account to buy the common shares, and you're putting up the vast majority of the money in your traditional account, in your 401k, to buy the preferred shares. And assuming that your investment works out such that you clear that hurdle of roughly 3 to 5% generally. So long as you clear that hurdle substantially, then what's going to happen is that you're going to have a good chunk of money landing in your in the Roth side of your 401k, even though it put up proportionately far less investment capital. So that's how that plays out.
Okay. Next question is there any income limitations to be able to contribute to the Roth side of the 401k?
You know, I don't remember offhand I don't think there are income limitations.
Not for solo 401ks. For Roth IRAs, yes, but there's no income limitations for solo 401k.
Yeah, thank you for being more on the ball with that than I am at the moment. Yeah, so no, there's not.
Okay, and great questions. I have a couple more. If you have more questions, put those in the question box. So are there any restrictions or limitations on the amount of investments that you can have within the preferred LLC?
No.
Okay. One question relating to the operating agreement. I guess this is more so for the attorney, but it's Is everything related to this strategy outlined in the operating agreement? I'm trying to piece together the question.
Yeah, it is. And having that operating agreement drafted precisely correctly is really, really, really important. So you will want to insist on using an attorney who's done this before, not even one who just kind of knows what it looks like but has never done it. You want somebody who has done this before, period.
Okay. Let's see, next question. This is more so internal to Advanta. Does Advanta have any plans to offer money market options for idle cash within the self-directed IRA? So currently at this time, we do not offer, if you have cash sitting in your account with us, it is FDIC insured, but it's just sitting there. I know there have been some internal discussions possibly, but at this time, we do not offer that. What I can do is, double check with operations and see if that's something that we intend to revisit in the future, but currently at this time, we do not. Bryan, so far that covers all of the questions. Again, audience, if you have any additional questions, feel free to go ahead and put those in the chat.
Yeah, they've asked me all of the common questions. I think they hit it pretty well.
Okay. Are there anything else that you would kind of highlight or talk about that hasn't been brought up in the questions?
Well, yeah, I mean, I just reiterate that the basic advantage or the basic benefit of this is that assuming that you have an investment that yields something reasonably well over that baseline of 3 to 5%, then what you can set things up in such a way where your tax liability on anything above 3 to 5% is going to be minimal, if not zero, and that can be a huge advantage. So it's well worth it to look into seriously for anyone who particularly for anyone who has at least $100,000 or $200,000 in their account, and certainly anybody who has accounts larger than that.
Okay, great information. Yeah, this is definitely an advanced strategy, and hopefully it added value to to someone in the audience to where they might see it as a viable strategy for their personal needs. Before we disconnect, again, if you have specific questions or you want to kind of reiterate or talk through self-direction, whether it's IRA related or solo 401ks, definitely feel free to reach out to me. Again, if you want to kind of talk directly or offline with Bryan, you can reach out to him at 770-833-8501. You can text him or you can email him at brian@bryanellis.com. Any parting words, Bryan?
No, just keep on, everybody, with your self-directed investing. I mean, there's nothing that beats the ability to do what you want with your money. Just keep on keeping on.
Yeah, I would agree with that sentiment. Yeah, self-direction definitely give you the control to invest in something that something that you understand. No one's going to be a better steward of your money than you are. So with that, I'll go ahead and end this recording. Happy investing. Again, feel free to reach out to Advanta at advantaira.com. Thank you so much, Bryan.
Thank you. It was a pleasure to be with you today.
Likewise.